It is in South Korea, where Bill Hwang was born into a humble household, that the narrative of Bill Hwang begins. This is a long way from Wall Street. Because his father was a preacher, Hwang's faith would become an important aspect of his life throughout his entire existence. He pursued higher education after migrating to the United States, first receiving a bachelor's degree from UCLA and then going on to acquire a master's degree in business administration from Carnegie Mellon University. Because of his background in a devout household and his academic pedigree, he possessed an unusual combination of humility and sharp intellect. These are attributes that would serve him well in the world of finance, which is a business that is extremely competitive. The beginning of Hwang's career in the financial industry was marked by a job at Hyundai Securities. However, it was at Tiger Management, where he was guided by the illustrious Julian Robertson, that his career truly took off. The hedge fund that Robertson managed was well known for its meticulous attention to research, discipline, and investing with a high level of conviction. It didn't take long for Hwang to impress his supervisor after he assimilated these lessons. After Robertson disbanded Tiger Management in the year 2000, he gave Hwang the funds necessary to launch his own company, which was one of the many companies that were referred to as Tiger Cubs. The new company that Hwang founded, Tiger Asia Management, concentrated on Asian stocks and had quick expansion. During its heyday, it was responsible for the management of assets worth more than $5 billion and was regarded as a success story among the Tiger Cubs. However, by the late 2000s, cracks started to emerge inside of it. Within the year 2012, Hwang and his company admitted to engaging in insider trading and manipulating the stocks of Chinese banks. The Securities and Exchange Commission, SEC, of the United States levied a penalty of $44 million against Tiger Asia. The fact that Hwang was prohibited from managing public finances was much more detrimental. A scandal of this nature would, for the majority of people, be the end of their career in finance. However, for Hwang, it was little more than a turning point. Instead of leaving the world of finance, Hwang decided to find a new beginning for himself. Through the establishment of Archegos Capital Management in 2013, he established a family office, which meant that it was solely responsible for the management of his personal wealth and was not subject to the same restrictions as a conventional hedge fund. As a tribute to Hwang's profound Christian faith, the name Archegos comes from the Greek language and means, one who leads the way, or founder. Throughout his life, he maintained his religious beliefs and made consistent contributions to charitable and religious initiatives through the Grace and Mercy Foundation, which he established. Archegos functioned covertly for a considerable amount of time. Due to the fact that it was a family office, it was exempt from the requirement that it declare its positions or adhere to the same level of scrutiny that is imposed on registered investment advisors. As a result of this regulatory blind spot, Hwang was able to grow his business without being discovered. Total return swaps are a sort of derivative contract that allows Archegos to get exposure to stocks without officially owning them. However, rather than adopting a safe investment strategy, Hwang made aggressive, highly leveraged wagers employing total return swaps. Through the use of swaps, Hwang was able to acquire substantial holdings in corporations such as Viacom CBS, Discovery Incorporated, GSX Tachido, Tencent Music, and Baidu, all while concealing Archegos' name from the records of shareholders. Credit Suisse, Nomura, Goldman Sachs, Morgan Stanley, and Deutsche Bank were among the many financial institutions with which he did business, yet, none of these institutions were aware of the entire scope of his exposure. Due to the fact that Hwang dispersed his trades over a number of distinct prime brokers, no single institution was able to obtain a comprehensive understanding of his risk. The consequences of this lack of visibility would be catastrophic. By the beginning of 2021, Archegos was managing a portfolio that was reputedly worth more than $100 billion in gross exposure. However, the foundation upon which it was built consisted of barely $10 to $15 billion in actual capital. An extraordinary amount of leverage was used to borrow the remaining funds. Hwang's technique was straightforward: he would buy enormous stakes in a few firms and then continue to drive those stocks upward. This effectively created a financial feedback loop that inflated Archegos' portfolio at an alarming pace. As the prices grew, he would use the gains as security to borrow even more money, which would result in the portfolio being inflated. However, the more difficult the ascent, the more terrible the fall will be. Viacom-CBS made the announcement of a secondary stock offering in March 2021, which was met with dissatisfaction from investors. The stock went down in price. An entire chain of events was set off by that one occurrence. Banks that had previously extended loans to Archegos started issuing margin calls, which are requests for additional collateral. Hwang, who had already exceeded his limit, was unable to make a payment. As soon as the banks became aware of the potential risk, they moved quickly to liquidate Archegos positions in order to recoup their loans. Nevertheless, the market for those stocks fell as a result of everyone selling at the same time. Within a span of just 2 days, Archegos fell apart. Stocks such as Viacom-CBS saw a value decline of more than 50%. The banks were in a hurry to get out of their investments. Goldman Sachs and Morgan Stanley were able to avoid suffering significant losses by acting quickly. Credit Suisse and Nomura, on the other hand, made a more gradual decline and experienced significant losses. Credit Suisse lost $5.5 billion, and Nomura lost approximately $2 billion. The magnitude of the fall caused Wall Street to be startled. In sum, more than $100 billion worth of market value was destroyed, and Bill Hwang's personal fortune vanished. According to reports, he lost $20 billion in approximately 48 hours, which is the quickest loss of this kind ever documented. The aftermath was a complete and utter mess. Regulators, lawmakers, and members of the financial media all questioned how a single man who ran a family office that was relatively unknown could pose such a threat to the entire system. What were the major banks' reasons for allowing such a situation to arise? What were the reasons for the absence of protections that would have prevented this form of covert leverage? It didn't take long before people started calling for more oversight of family offices. An indictment against Hwang was handed down in April of 2022, and the allegations against him included racketeering conspiracy, securities fraud, and wire fraud. According to the prosecution, Patrick Halligan, the chief financial officer of Hwang and Archegos, misled banks about the company's assets and engaged in manipulative trading in order to artificially inflate stock prices. The indictment portrayed a picture of dishonesty and recklessness, charging that Hwang intentionally misled banks in order to gain additional leverage while simultaneously manipulating markets through enormous, coordinated purchases. When Hwang entered his plea of not guilty, he maintained that he had faith in the businesses in which he had invested and that he had no intention of defrauding anyone. The court case is still ongoing and is being constantly monitored, not just because of the magnitude of the collapse, but also because of what it shows about the weaknesses of the contemporary financial system. In addition to the courtrooms and balance sheets, the Bill Hwang saga has become something of a modern morality tale. It serves as a warning that even in the world that emerged after the financial crisis of 2008, where financial rules were intended to discourage excessive risk-taking, new loopholes and blind spots continue to appear throughout the world. The collapse of Hwang was not the product of a Ponzi scheme or accounting fraud in the usual sense, rather, it was the result of legal financial tools that were inadequately regulated, which were facilitated by some of the most reputable banks in the world, and which were constructed on a foundation of opaque leverage. His life, which was previously a unique combination of unassuming religion and enormous financial power, is now at the focus of a more general discussion: how can we stop the future Archegos from happening? When unregulated financial engineering is combined with personal conviction, what results would you expect? And who, in the end, is the one who is forced to pay the price as a secret empire falls apart overnight? Thanks for watching. Don't forget to like and subscribe to our YouTube channel.